bond quiz and other long-term liabilities review for your Chapter 14 quiz on Pearson. First thing you're going to need to know is how to book the issuance of bonds. So in our example, on January 1st, ABC Company is going to issue 6% 10-year bonds, and these bonds have a face value of $200,000. They pay interest semi-annually, and they're being issued at a price of $90. And what that means is that for one reason or another, typically because our interest is worse than our competitors' interest, people are not going to pay the full $200,000 for these bonds, so we have to entice them to pay it by giving them a little something off. In this case, that something off is we're not going to issue them at full price, we're going to issue them at 90% of full price. That's where the bond price of 90 comes from. So the journal entry here is on January 1st. We are going to debit cash, and we're going to debit for $180,000, which is that 90% of our $200,000 face value. The difference between the amount of cash we receive and the face value of the bonds is the discount we are giving our bond holders, and we're going to put in an account called discounts on bonds payable for 20 grand. And lastly, we're going to put the bonds on the books. Even though we are issuing them and getting $180,000 now, we still have to pay back face when their life is up, when 10 years pass on these 10-year bonds. So we're going to put the bonds payable on our books, not for the $180,000 we're receiving, but for the full $200,000 of face. We issued bonds at a discount. Now those bonds are out there and in the hands of bondholders. Well, we need to pay them a little something extra in the form of a series of periodic interest payments. So on June 30th, ABC Company is making a semi-annual interest payment on these 6% 10-year bonds. We're going to get rid of the discount. The discount on bonds payable can't stay on our books because it needs to be at zero by the time we pay the bonds off, so that the full liability our books are showing are the actual amount that we're going to repay. We're going to use the straight line method. And the straight line method is the easiest method for amortizing a discount. You just simply take an equal portion away each period. So in our June 30th entry, we're going to have a debit to interest expense. We're going to have a credit to discount on bonds payable. And we're going to have another credit to cash. How much goes in here? Well, the amount of cash is the amount of actual interest that we are paying to our bondholders. We can figure that out by taking the following formula, which is face value times stated rate times time equals interest. Our bonds, as we know from the last slide, have a face value of $200,000. The stated rate on them is 6%. And the time, it's a semi-annual interest payment. That means twice a year, so 6 out of 12. 200,000 times 6% times 6 out of 12 means we're actually paying $6,000 in interest, and that's the amount we are going to credit to our cash account. To amortize our discount, we're going to use a formula where we take the original amount of the discount at the time we issued it and divide it by the number of times we're going to pay interest over the bond's life. Our original discount was $20,000. The number of times that we are going to have to pay interest on this bond, we have to pay it twice a year for 10 years, so 20 in total. And since we're using straight line, we're going to take an equal portion of that discount away every time we pay interest. 20,000 divided by 20 means we're going to take away $8,000 worth of our discount every time we pay interest. And to finish this entry, we are just going to debit interest expense for whatever makes our debits equal our credits. That is $7,000. We paid semi-annual bond interest. On December 31st, we're going to make our next semi-annual interest payment. Bonds are still 6%, they are still 10-year bonds, and they are still being amortized using the straight line method. So on December 31st, we're going to have the same three accounts be affected: interest expense, discount on bonds payable, and cash. We're going to figure out cash, which is the amount of actual interest we're paying, by using the same formula, face times rate times time. The face value of the bonds is still $200,000, the rate is still 6%, and the time is 6 out of 12. And if we multiply that out, we once again get $6,000. We're giving $6,000 in cash to our bondholders, so we credit cash for $6,000. Amortizing the discount, we're going to use the same formula here as well. The original discount divided by the number of payments we make over the bond's life. It was a $20,000 discount. Our 10-year bonds pay twice a year, or 20 times in total. So we're going to take away $1,000 of that discount every time we pay bonds. And interest expense is still going to be $7,000. Make our debits equal our credits. We're paying semi-annual bond interest one more time. And you would probably noticed by now this is the same exact entry as we had the last time. It's true. Whenever you use the straight line method, every time you pay interest and amortize your discount, the entry is going to be exactly the same every single time over the entire bond's life, because none of your inputs change. Your face value is always going to be the same. Your stated rate is going to be the same. The time that it takes to make payments, interest payments, is always going to be the same. And then for your amortization, the original amount of discount is going to be the same. The total amount of payments is going to be the same. Since none of the inputs are changing, the entry to record interest payments on a bond is exactly the same every single time, as long as you're using the straight line method. Speaking of the end of a bond's life, we're going to pay those interest payments the full 20 times, and then when we're done and 10 years has passed, we pay back the principal, or the face value of the bond. So this is January 1st, but this is January 1st 10 years in the future, when the bond is mature and ready to be paid off. And to do so, we need to take the liability for the bond off of our books. We put it on at face value, we have to take it off at face value. So these bonds have a face value of $200,000. We're going to debit bonds payable for $200,000. We're going to credit cash for $200,000, and we retired our bonds at maturity. Another form of long-term debt is a notes payable. It's borrowing from a lending institution. In our example, on April 1st, ABC Company is signing a $250,000 5-year 10% notes payable with Commune Bank. When you sign that promissory note, you're saying that you're going to repay. Your repayment terms are going to be laid out in the note. Their repayment terms are that they have to make 5 annual payments of $50,000 plus interest on March 31st of each subsequent year. So the first thing we need to do is record the signing of the note, and you should have seen this in financial. It's exactly the same here. What are we receiving? We're receiving cash. How much? $250,000. How are we getting that cash? We are signing a notes payable, so we credit notes payable because it's liability. Liabilities go up on the credit side. Credited for $250,000. We signed a 5-year 10% note. Accruing interest on the notes. So at the end of each year, we need to, or end of each reporting period, we're going to assume it's a year for this case, we need to put all the interest that we know we owe at that point on to the books. So we're going to have to throw in a adjusting entry at the end of the period that is going to be a debit to interest expense and a credit to interest payable. How much interest do we owe? We can use the same formula. Principal times rate times time equals interest. In this case, the amount of interest we're accruing. So the principal is how much money we still owe on the note. We haven't made any payments. We still owe the $250,000. The rate is stated on the note at 10%, and the time is how long it's been since we signed the note that we are accruing interest for. We signed the note on April 1st, which means all the way from April 1st to December 31st, interest has been building on this note. That is a time span of 9 months, so we're going to use 9 out of 12. $250,000 times 10% times 9 out of 12 means that we have $18,750 worth of interest that we know we owe at this point, and we need to put on our books in an adjustment. So we are going to debit interest expense for $18,750. We're going to credit interest payable for the $18,750 we accrued interest on a commune note. When March 31st of the next year rolls around, we have to make our first payment. So our first payment, stated in the terms, we have to give them $50,000 plus all interest that is built up during the year on this note. Throw in the date, and we're going to have a debit to interest expense. And to figure out how much that debit to interest expense is for, we use the same formula that we had before. We still owe the full $250. This is our first payment. We haven't decreased our principal at all. The rate is still 10%, and the time is going to be how long it's been since we last put interest on the books. Well, we put interest on the books on December 31st, which means January, February, and March have passed, and that is 3 months. So let's multiply it by 3 out of 12. 250,000 times 10% times 3 out of 12 means that we need to put another $6,250 worth of interest on the books. We're going to put that in as an interest expense. We accrued interest at the end of December and made that liability interest payable. We need to take that off the books because we're paying off that as well, and that's the same number. It was $18,750. And we're going to have one more debit, and that is for the amount of our payment that goes towards principal. The terms of our note say we have to pay $50,000 plus all interest that was owed. Well, the $50,000 is the amount that is going towards principal. And since it's going towards the principal on a note, we need to decrease our notes payable. So we're going to debit notes payable for $50,000. And we're going to end this journal entry by crediting cash For the sum of all of the interest and the amount that's going towards principal, and we add those three up, we get $75,000. That is our first annual payment to Kami. Let's accrue some more interest. At the end of this year, on December 31st, 2020, ABC Company is going to accrue interest one more time on its $250,000 5-year 10% notes payable with Kami Bank. Well, this is going to be the same setup that we had last time when we made the accrual of interest entry. It's a debit to interest expense and a credit to interest payable. We're going to use the same formula. The only difference being in the formula this time is we don't owe the full $250,000 anymore. When we made our payment on March 31st, $50,000 of it went towards principal. Since we borrowed $250,000 in the first place and we paid off $50,000, now we only owe $200,000. The rate is going to stay the same. It is 10%, and again, time is how long it's been since we put interest on the books. We put interest on the books when we paid it off at the end of March, which means April through December has passed since we put interest on the books. That is a span of 9 months. Now our interest accrued is $15,000. So we're going to debit interest expense for $15,000, and we are going to credit interest payable for that same amount. We accrued interest on the Kami note one more time, and this is just going to keep happening every time it goes through. Every time you have to accrue and pay off interest, the amount of principal you have remaining is going to decrease from all of those $50,000 principal payments, which means the amount of interest in each subsequent entry is always going to get smaller. When we report how much we still owe on a notes payable, you have to break it into two portions: the amount that you have to pay within the next year and the amount that is due more than 1 year in the future. Well, at the point that we're at right now, we owe $200,000 on this note. But $50,000 of that we know is due in the upcoming March, and the remainder is due years in advance. So when we break down our note, when we report it, the current portion is the amount that we have to pay within the next year, and that's $50,000. We owe $200,000 at this point. $50,000 is due in the next year, which means the remaining $150,000 is due in at least a year or more. So that other portion that we have more than a year to pay goes into long-term debt. But still, when you add the two of them together, the total liabilities related to this note, $200,000, is equal to the remaining principal balance of the note. Another type of long-term debt is going to be our mortgage. Mortgages are loans that you take out in order to acquire one specific asset. So on December 1st, 2019, ABC Company is going to sign a $550,000 7% mortgage payable with Crest Bank, and we're going to do so to acquire a building. To pay off this note, we are going to make monthly payments of $10,000, which cover principal and interest. This is a much more standard method of paying off debt, where they give you a fixed amount that you have to pay each month, and a portion of what you pay each month goes towards principal, and a portion of what you pay each month goes towards interest. What we need to do is figure out what portion of the $10,000 when we pay is going towards principal and is going towards interest. First thing we need to do, however, is put this on the books. So on December 1st, we are signing this mortgage to acquire this building. Well, the building is the asset we're receiving, so we're going to debit building for $550,000. And I will give you fair warning, in Pearson, in this entry, they have the debit to cash. I guess they're assuming they're going to get the cash and immediately turn around and get the building. I don't see the point in doing two entries. I have always just debited the asset that I'm acquiring, but for you guys, Pearson for some reason wants cash to be the debit in this entry. We have a credit, and a credit is to the liability we're creating. Well, we're taking out a mortgage to acquire this building, so let's credit mortgages payable for $550,000. We signed a 7% mortgage with Crest. Let's accrue some interest at the end of the year. On December 31st, we accrued interest on this $550,000 7% mortgage with Crest Bank. Well, on December 31st, it's an accrual entry for interest. It's the same setup that we had for the note: debit to interest expense, credit to interest payable. And to figure out what it is, we're going to use the same formula: principal times rate times time. We owe $550,000. That was the size of our mortgage. We've not made any payments, which means our principal right now is still $550,000. If we multiply that by the stated rate of 7% and the amount of time that has passed, we're going to get the amount of interest we had. Well, how much time has passed? We signed it December 1st. It's now December 31st. That's 1 out of 12. So 550 grand times 7% times 1 out of 12 means that we are going to accrue $3,208.33 worth of interest. I'm not a huge fan of pennies in journal entries, so let's just call it $3,208 rounded off. Debit to interest expense, credit to interest payable. We accrued interest on this note to commune. When we make a payment, let's make our first payment on January 1st, 2020. ABC Company is paying $10,000, and it's going to go a portion towards principal and a portion towards interest. So the date comes in January 1st. We're going to have a debit, in this case, the interest payable, because we put the liability on the books at the end of December. And that's going to be for $3,208. We're paying off our interest payable that we already put on the books. We're going to have a debit to mortgages payable. Well, how much is that going to be for? Well, we know our payment in total is $10,000, and we know $3,208 of it is going to go towards interest, which means the remainder must go towards principal. So if we take $10,000, subtract $3,208, we figure out that $6,792 of this $10,000 payment is going towards the principal on our mortgage. And the last part of the entry is to credit cash. For the amount of your payment, our payment is fixed at $10,000, so we are going to credit cash for $10,000. We paid January's mortgage to Crest. We are going to make our second payment of $10,000 towards our mortgage. Setup for this is incredibly similar. Only difference being our debit this time is going to be the interest expense. We're assuming the ABC Company only puts adjustments on its books at the end of the year, which means we didn't have any liability sitting around at this time, so we're just going to debit interest expense using the same formula that we had before, principal times rate times time. The amount of principal we have was $550,000 when we signed it, but last month we made a payment, and $6,792 of that payment went towards principal, which means at this point we only owe $543,208 on this mortgage. And if we take that remaining balance, we multiply it by 7%, and we multiply by 1 out of 12 because it's for a month, we find out that this month we are getting hit with $3,168.71 worth of interest. So we're going to debit interest expense for $3,169. Same deal that we had before. We know it's a $10,000 payment, and we know that $3,169 of that payment is going towards interest. Well, the remainder must be going towards principal. So $10,000 minus $3,169 means we have mortgage payable getting debited for $6,831. However, the total amount of the payment is still $10,000, so we're going to credit the cash. We paid February interest to Crest on this mortgage. This is a mortgage table, and the same things that we had when a company takes out a mortgage, they'll typically go and they'll make a huge table that tells their accountants exactly what portion goes towards principal and what portion goes towards interest each and every period. December 1st was the day that we signed this mortgage, and we signed it for $550,000. With a table, whatever you end the prior period with, you have to begin the next period with. So let's begin January 1st with that same $550,000. We did our math. We figured out that $3,208 was going towards interest in that first payment, and that the remaining $6,792 was going towards principal. We had a total payment of $10,000. What was our ending balance? It was the beginning balance on January 1st minus the amount that went towards principal, that's $6,792. We came up with $543,208 that was left. Well, if we ended January with $543,208, we must begin February with the same amount. So we're just going to bring that number over to be our beginning balance. We went through and we did the math. We took our beginning balance times rate times time to figure out our interest for February. It was $3,169. And then we took our total payment of $10,000, subtracted out the interest expense that we just found. That became $6,831, and our total payment was still $10,000. So to get to our ending balance, we take our beginning balance, we subtract the portion that went towards principal, and we come up with $536,377. For March, the beginning balance is whatever we ended February with, that same $536,377. We take that number, we multiply it by rate, and we multiply it by time. In March, when we do the math, we're going to figure out that we owe $3,129 in interest on this particular mortgage. And if we're paying $10,000 and $31.29 goes towards interest, well, the remaining $68.71 must go towards principal. So our total payment is still $10,000. That number's never going to change. And to get to our ending balance, we take our beginning balance minus our principal payment for the period. $536,377 minus $6,871 of principal payment is going to leave us with $529,506 that is due at the end of March. And this is going to repeat itself over and over again for the entire life of your mortgage. If any of you have Excel skills, I highly advise you to make this table in Excel for the purpose of doing this quiz, because you're going to have to fill in all the boxes with Excel. If you know how to make formulas and fill handle, it will auto fill in. It'll be so much faster than having to do the calculations every single time. So lastly, how do you report mortgages on a balance sheet? It's the same concept with all liabilities. It's current if it's due within the next year, and it's long term if it's due at least 1 year in the future. So the portion of mortgages payable that you report on current liabilities, you would go, say, back to this chart, and you would figure out what your principal payment is for the next 12 months. Add them all up, and that is your current portion of your mortgage, which means that your long-term debt has to be everything else is due on your mortgage. And my hint to you guys is go a year in the future. Whatever your ending balance is 1 year in the future has to be the amount that you report for long-term debt. Good luck on your quiz, everybody.